Apple. All right, let's start Apple. So let's rewind the price action on Apple down to October lows, October 2023 lows. Left. Actually, yeah, that's fine. It's good. It's good over there. Yeah, you can place the cursor. Good. All right, let's zoom in. So let's take a look at the monthly chart, and then we'll go to weekly. Okay, so the monthly candle looks pretty bad. It's very banged up. But in terms of market structure, it's a bullish market on the monthly. It's just making higher lows and higher highs. So what I would see is that the pullback which is happening is more like a it's gonna put in like a higher low, and we should be looking for a higher low formation on the monthly. So how about you mark out some of the monthly SR levels, and then we'll go to the weekly chart. You don't have to go that far back. 2021 is like 4 years behind. The market is not going to care about 2021 and 2024. So care more. The market cares more so about what happens like in last year. So like going back to like 2023 and 2022. Just focus on SR levels which are present in the recent memory. Okay, good. So just to let you be aware, this high which you just made, 176, it has some kind of a bearish order block within it, which caused a sell-off to happen, and that sell-off broke market structure to the downside. It's not visible on the monthly chart, but if you go on the 3 week or 2 week or weekly, you will see a bearish order block in that area. Right, so that up candle, right? The weekly up candle? Yes, this one. That's a bearish order block. The left one, not the wick, the giant up candle. Yeah, this one. So that's a bearish order block which turned into a breaker. That's a breaker, not a resistance. Do you understand why that's a breaker? Yeah, that's true. It did. Now within that breaker, zoom in and see if you can find a weekly support zone. Yes, within the breaker. So on the right side, when the market tries to push above the breaker, there's some consolidation. You will notice that consolidation formed a support zone. Good job. Zoom in now. Zoom in a bit more. Keep zooming in. See the gap up? There's a giant gap up within the breaker. Yeah, that gap up. This one. Yeah. So mark that out. And now go to the weekly chart. Where is that gap up forming? In that weekly candle, which made the push. So on the left side, you see the down weekly candle, which got engulfed to the upside. No, 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 on the right side. Just very close to the levels you've drawn out. Go left. Where you drew the levels for the gap? No, no, go left. Keep going left. Yeah. On the left side? Yes, here. See the down candle on the weekly chart? This one, yes. So pay attention to that down candle. Um, the next week, market took out the lows of the down candle and then got completely engulfed to the upside. That is a bullish order block. And that bullish order block was responsible for breaking that weekly resistance zone and turned it into a breaker. So now you know that you have a weekly bullish order block, you have the open gap on the daily chart. So once you fill the gap on the daily chart, that is a long, and your stop loss is going to go below 164. So go on the 4 hour chart now. Go to 4 hour. If you have to execute on daily levels, which you, oh, okay, go on the daily chart. I mean, you kind of know what happened now. So, but still, like for the sake of, go right, 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 right. Yeah, here, exactly there. Yeah, okay. So now, when you're looking at the daily chart like that, you should have the open levels for the daily gap sitting over there. Once you come down to fill the gap at 167.04, that's where you enter the long position, and your stop loss is going to be below 164, which is below the support zone. Okay. So when you see the market jump like that, it's important to go on the weekly chart and see what it's doing on the weekly chart. So the market, zoom in a bit more. Can you spot the inside weekly candles? Yeah, these ones. So you need to have them marked out as well. Because when you drop below and you tested the weekly support zone, your target is going to be the upside liquidity of the inside weekly candles. On top of it, you have a weekly bearish order block setting up top on the left side. Go left. See the giant up candle before the sell-off happened? Yeah, this one. That up candle is a very, very nice bearish order block. So now there's a battle now. Think of it this way. You're sandwiched between a weekly support zone, which is being tested for the first time, and you're also sandwiched between the weekly resistance zone, which is also being tested for the first time. So when it comes to the support zone, you long it, but when it goes and tests the resistance zone, you close your long and you short it, right? So your take profit is going to go at the liquidity pool setting at 180.30. So go on the daily chart. Your profit target should have been hit when those highs were taken out. Now, the important thing to notice over here is that there's a massive gap which is sitting within the resistance zone, and that would have been like a very strong signal that you should be taking profits and entering short position when testing that gap. Because generally speaking, when in stocks specifically, whenever there's like a gap up and there's a resistance zone on the higher time frame where the gap is formed, the market is routing into the resistance zone to fill the gap. And once the gap is filled, the inefficiency is filled, and the market is going to reject the resistance and it's going to come down. Okay, so when it's in a resistance zone, that's where you go short, but when it's in a support zone, that's where you go long. Now, the other thing to realize is that the support zone, the gap on the support zone at 167.04, it's not fully filled. Like there's a little bit of a gap left open on the downside. Yeah, this one. So when the market came down, it did not tap that level perfectly where you enter the buy position. So there's still a chance that the market can go down and it can take out the low at 167.59. Yeah, play it out. Now that's where you buy. And buy at least 100, not one. You need like bigger size. Now put the stop loss below 164. Yeah, that's good. That's good. And now play it out. Now before you play it out, I would like you to go to the weekly chart. Just look at the market, how it looks like on the weekly chart, and see what you are looking at. So we're looking at the market tapping the weekly support zone properly, and it's rejecting it, going up. We have tested the weekly resistance zone at least once, which means if we go and tag the weekly resistance zone another time, it is likely going to break out. So your profit target should be going even further up. I think you should be taking it, go up, go to 192, 192. There's a gap, the fair value gap. That's what you should be targeting between 192 and 190. Yeah, basically right below that weekly bearish on block. Yeah, that's good. So the market should be tagging that. If we flip the market structure, now go on the monthly chart and see what the monthly is doing. Okay, so we took out the monthly low. All right, nothing special on the monthly. Let's see what happens on the daily now. Now play it out, play out the price action on daily. Pause, 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 pause. Zoom in at the very bottom, like where the bottom was formed. Do you see the inside daily candle it formed before bottoming out? Yeah, over here. So when the inside daily candle was formed, it gapped up the next day and it broke above the inside daily candle. And then on the third day, the market came down and it filled the gap right to the dollar, rejected, and then rallied higher. And then it kept rallying higher again. Is that true? Can you spot that? Yeah, over here. Yes. Yeah. So whenever the market has to bottom out, market will never leave any gap open before the bottom is properly printed and it goes higher. All right. So that's how I know that the market is not going to come down, and you should be moving your stop loss higher on every daily candle as it's pushing higher. Whenever a gap gets filled and market pushes higher, you move your stop loss to it. Yeah, that's where you keep your stop loss. And yeah, I think the daily market structure just shifted bullish. Right. So you're tagging the resistance zone again. So my thinking would be it should give some consolidation, but it doesn't have to because we already tested the resistance zone properly last time, so we can like just rocket past this resistance zone and go for um, the gap fill where you have the profit target. So play out the price action, see what happens. Pause. So you see there's an inside daily candle and it's breaking out of the inside daily candle with a gap right now where it did that. Okay. So pay like just make note of it that there's an open gap which was sitting over there and there was an inside daily candle and the market gapped up. At some point, the market is going to come back. Right. You need to be on the daily chart. That's good. So the market gapped up after printing an inside daily candle. So my thinking would be that the market wants to go and take out the liquidity to the upside. It's going to fill that gap, and then we'll see what happens from there. But you should have this inside daily candle mapped out, as in like keep it for future reference. That this was like untapped liquidity on the downside, which the market has not taken out, and it's just pushing higher. Yeah, there's an open gap there. Good. Okay. Play out the price action. So is our target met now? We tagged 192. If you go on the weekly chart, you will see the fair value gap got filled. 192.5. Go on the daily. Play out the price action further. Another inside daily candle. and that's where it got filled. You should be shorting it, by the way, over there. Try a short because it's an inside daily candle failure. Like you see, there's an inside daily candle which was formed, and it took out the liquidity, tapped the weekly fair value gap, and it's rejecting it. So your target is going to be the next inside daily candle low. So the target will be like somewhere around 189. Yeah, so keep the stop loss right above the high. Yeah, and take profit is going to be 189. Not that low, just the nearest high. Like we don't know if it's gonna come all the way down there just yet because you took out like a weekly high right there. Yeah, something like that. So play out. That is it. Done. Now see the thing is, use your red resistance zone and really focus into the daily breaker. Like you see the last up candle before the giant drop which happened on the left side in September. Yeah, this up candle. So basically, zoom in your red resistance zone and just put it on the daily candle instead. That's your daily breaker. Right. Yes, just like that. Good. Now, this is one of the reasons why I'm saying that the market may not go to the open gap, which we have at 186, because this daily breaker is a support zone. We just broke above it. Okay, so when we're coming down, the market may find support in this area. Okay, so play at the price. Your daily breaker is not fully formed. Like you need to include the low of the daily candle too to be considered in the daily breaker. So you see the red zone. It should be all the way to the bottom for the candle. The wick as well. No, no, no. Just the daily candle's wick. Yeah. Yes. Like that. The wick. You discarded the wick. Yes. Yeah. Like this. Okay. So play out the price action further. Hmm. Okay. Hold on. Hold on. Zoom out. Zoom out a little bit. So you see the highs on the left at 200? The market's gonna likely run up to those highs, given how the price is consolidating. It's not selling off. This is called consolidation. It's going sideways, and it's testing the support zone. So since it's basing above a support zone, most likely it's gearing up more energy to run up further liquidity to the upside. So we should be going to 198. Most likely, I think it should be going to 198. You could try a buy on that. So your stop loss is going to be at 186. Yeah, that's good. Below the daily breaker. And take profit is going to be 198. Bingo. All right, we took out the highs. Now it's time to zoom out and look at the weekly chart because we're at all-time highs now, so there's nothing above. We still have that um, open gap which the market has to fill, but the daily support zone, the daily breaker, which we used to buy, that support zone is fully tested. So if it comes back down, it's not going to hold. All right. That support zone is basically nullified. It's not a good support zone to buy at all anymore. So Go to the weekly chart. Now pay attention to the weekly lows. The nearest weekly low, that's your new invalidation level. No, the other one on the right. Yeah, this one. So 191.42 is your invalidation level. Moreover, we have a weekly breaker now. You should have the weekly breaker drawn out too on the left side because the market pushed above new all-time highs. So the bearish order block is now a breaker. Yeah, this one. Yes. We should always like be on the lookout for any resistance zone which gets broken that acts as a support zone when the market pulls back. Let's go on the daily chart. So we have our invalidation level, we have the weekly breaker. Now let's see what happens. Now zoom in. Hold on. Pause. Zoom in. See the inside daily candle? We made an inside daily candle, gap lower, and then the market came up, filled the gap, and then rejected it. Yeah. Now, the market does not actually have to go up and take out the highs because it filled the gap. Like it filled the gap and it rejected by filling the gap and it created a bearish order block on the daily chart. That's a very, very proper bearish order block where it took out the highs, rejected it, and then it's coming down. So you should mark the bearish order block. Yeah, that's a strong resistance zone. But now the market is in a pickle. The market should not go below 191.42 because that's going to break market structure. That's the previous week's low. But we have a daily bearish order block. So if the weekly structure has to hold, we have to find support somewhere between here to like 192, and we have to flip the daily bearish order block back up again and turn bullish again. There is actually no position for us to take over here. For starters, like you should not be thinking about being in the market all the time. If you don't have information which is supporting your any kind of a trade setup, if it's not giving you an edge, there is no reason for you to be in the market. Because right now we're sitting above a weekly breaker, which is a support zone, but we have created a daily bearish order block, which is a resistance zone. Now we don't know if that 191.42 low is going to break or not, but it has to flip above the daily bearish order block and turn the daily resistance zone into support zone, and then I'll go long again. Okay, until then, just like stay there and do nothing because you don't short into like a weekly support zone, right? You just like let the market develop furthermore. So play out the price action and see what happens. Now you see how the market came up and tested the daily bearish order block on the next day, and it took out the weekly low. So that's a yeah. So it did not go above the daily bearish order block. It held it as resistance, rejected it, came back down, made a lower low. It kept selling off until it took out the previous week's low, right? Now go to the weekly chart and see how the weekly candle looks like. So we have the inside weekly candle now in Apple. Uh, you should mark the inside weekly candle. Good. Now, what day is it when we took out the previous week's low? It's December 27th, which means we're coming to the end of the year. It's holiday season. We just had Christmas. The market is not going to be doing much, as in like it's zero movement in the market. So you should wait till like 2nd January when the new monthly candle opens and the new yearly candle opens, new quarterly candle opens, and we'll decide on trade setups after that. So fast forward to 2nd January. Wait, what date is that? So the market opened on 2nd January with a gap down. And where did we go? Back down to that open gap, which we had setting way back in November. So that's filled. But we have a new gap which is open up top. And the market is likely going to fill that. But now the first thing you got to do is you got to draw some support zones and be on the lookout on where the market is going to bounce from. Yeah, that's a gap. So can you do one thing? Click on select bar. Click on select bar, and then click on, yeah, just click here. Good. Like at least those names kind of go away. They were very annoying. Now you gotta draw some support zones where the market is falling because you don't have any levels or anything drawn out where the market can find support. Because the market doesn't go down in a straight line. It always like finds some kind of a support, bounces, fills the gap, tags resistance, then it's gonna go down furthermore. So this level you drew is actually a very good level. Like that's a monthly level. So very good level. So once you fill the gap, do you short or do you long? That's the question you gotta be asking because you just made all-time highs. You're coming down to tag the level at 182. That's a monthly level. So it's going to give you some reaction. But once you get the reaction and then you do the gap fill, do you short it or do you keep holding the long position, anticipating new all-time highs? Yes, you need to short it because you broke weekly market structure. You see the weekly lows we all took out? Those were like very, very strong weekly lows. And when you break weekly lows like that, any bounce which happens, you have to short it. Like it's gonna make some kind of a lower high, and the market's gonna come back down to tag further support zones on the downside. So do you see the daily breaker where you have the monthly level drawn out? Good job. You see, daily breakers are very important, at least in stocks they are, because the market does not retrace so deep in daily. It almost always like respects daily breakers whenever you find one. Put a stop loss below there and target the gap fill. Yep. No, gap fill is good. No, all the way to the top. Yeah, that's good. The other price action. Sounds good. Now, where exactly is the market going now? It's going into previous resistance zone. Oh, sorry. Go on the weekly chart. Like we need to see what the weekly candle looks like because we have new information now. Right. So this inside weekly candle, which broke down with the gap, that's a bearish order block now. All right. So take the yellow zone, which you have from like the breaker, and use that as a resistance zone for the up candle. Now keep the red zone. That's a very important daily bearish order block. That has to stay. Yeah, this weekly bearish order block, it's an important bearish order block, and within the weekly bearish order block, we have the daily bearish order block, which is the red zone you've drawn out. Okay, go in the daily chart. Right, so that daily bearish order block is where you're going to short the market if it gets there. Basically, the market should not be going above the daily bearish order block if the weekly bearish order block has to hold. So think of it this way: the market structure is in your favor. You broke market structure because you took out key weekly lows. Even though the daily breaker is holding support, you're anticipating that the bounce which is happening in the market is going to create like a lower high on the daily chart because you're in the weekly resistance zone, you're in the daily resistance zone as well. So there's daily resistance zone, weekly resistance zone, and the market structure is bearish. So once it gets there to the daily bearish order block, that's where you short it, and you keep your stop loss right above the daily bearish order block. Okay, let's go. Play out the price action. Get ready. Short it. Short it. And put a stop loss at the daily bearish order block. No. Yeah, the high. A little bit higher. A little bit more higher. Like you see the swing high? The swing high, yeah, that's this one. Good. And target new lows at 180. Yeah, like that. No, just 180 is good. Okay, play out. So is it blowing your mind at the moment on how I'm like trading the largest company in the world just using price action concepts, simple SR levels, breakers, auto blocks, and that's all. That's all you need. Like I'm not even doing elite wave at the moment. It's like just like price action concepts. So you see how the last candle it went up just a little bit on the wick, filled the gap, and then fast down, like the latest candle where you had a very, very large drop. Like zoom in into that candle. Zoom, really zoom in. So mark the gap, the open gap over there. Yes. So whenever you see a very thin gap open like this, now zoom in on the 4 hour chart. If you can go to the 4 hour, you're gonna like lose some of the replay, but that's fine. Just go on the 4 hour chart and like go back. No. Right, just right there. Go in, zoom really deep in it. Yeah. So this candle, the giant sell candle, it happened. I'm gonna see the time for that. Just hold on a moment. Let me find out. Oh, it was a gap down. Like it had earnings that day, I think. Like something happened. Yeah, but it had earnings, so it had an earnings gap down. I was like, what the hell? Yeah, that had earnings, but so the market gap down, tagged your target, and then it basically recovered on the earnings and it bounced on the earnings. Okay, do me a favor. Yeah, on the hourly chart, go on the hourly chart and go all the way back where you had the price action of the drop. Yeah, so from the daily bearish order block where you rejected up top, draw the Elliott wave from the top all the way to the bottom where the earnings happened. Okay. So then you're doing it incorrectly. First things first, determine the lower highs. If you're having trouble deciding where to put the wave two and wave four pullbacks, just take a horizontal ray and mark all the lower highs using the horizontal ray so that you have like a proper visual of where the lower highs are. Because every lower high which is being printed is some kind of a wave two or some kind of a wave four. Okay. So from all the way to the top, just have the lower highs mapped out with the horizontal rays. Good. Now you left the top levels, which are in the daily bearish order block at 196 and 196.5. Yeah, this one. And the very top one, like on the left of it. Yeah. So you see how it did not make a higher high over there? And you missed that. Like you need to be taking into consideration that the highest high, the 196.371, it had an initial sell-off and then it had a bounce. That bounce made a lower high. It did not go up and make a higher high. That lower high had another sell-off and then we went down very fast from there. So zoom into the hourly chart at the daily bearish order block. Like go into the price action over there at 196.37. Yes, right there. So you see how the two levels are kind of overlapping at 196.37 and 196.27? Like it did not make a higher high over there. So in Elliott wave standpoint, that's technically a lower high. So this bounce which is happening, that's your wave two. So the initial sell-off was wave one. That bounce which happened is wave two, and then the wave three started. And the wave three is supposed to be the largest of all. So think about it from like a subdivision perspective, that you're subdividing the entire wave three. And the earnings gap down is the wave five. So whenever you have like earnings coming up, think of it this way. Every earnings move which happens in the market is some kind of a wave five. It's always a wave five. Like the majority of the trend is like almost done and earnings comes in and you have like a large spike happening in either direction. That's almost a wave five. And then you have like a reversal happening from there. So your wave three is incorrect. You have to think of 1, 2, 3, 4, 5 for the entire wave three. Yeah, that's good. Very good. So draw the subdivision of the wave three as a 1, 2, 3, 4, 5 so that you can like properly visualize what the wave three is. Yeah, that's good. So give it like a different color and a different degree to it. Okay, good. Now the reason we draw the Elliott waves is so that we can have perspective on when the wave fives are coming to an end, and if you have like a very proper 1, 2, 3, 4, 5 to the downside. Because once you have 1, 2, 3, 4, 5 to the downside like this, and you're just going through earnings where you have a massive gap down, the bounce which is going to happen, it's going to be a strong bounce, and you should not be shorting it like just off the bat. So in that case, you will be taking a fib all the way from the top where the daily bearish or block rejection happened and measure the pullback from the earnings bottom. And I see where the rejection happened at 0.618 or 0.705. Like the moment you went there, rejected it, came down, a lower high was made, and then it just kept selling off. And that's where you would have like enter short again. So whenever you have like a wave four pullback, which you drew right there, a wave four pullback in itself is a bearish order block information. So the up candles which are happening in the wave four pullback before the sell-off happens, it's basically creating a bearish order block. So that's why it's useful to have some kind of an Elliott wave count in front of you, so that you can at least anticipate that when the bounce is happening, it should not go above the wave four high, like the red one which it drew, and it's a bearish order block in itself. It may not be visible on the hourly chart, but those four up candles, it could be like a bearish order block on the 4 hour chart. So once you go to the 4 hour chart, you're going to see like an up candle formed over there, which is a bearish order block. And that's where you short it into the 0.705 fib, and then it sells off from there. Like on the 4 hour chart, I'm going to zoom in. So you see the up candle where you have the wave 4 drawn out, the red wave 4, the up candle in the 4 hour. That up candle is the bearish order block. Yes. So when the market is bouncing and it's going up strong, at least you're aware that the bounce is going to last only till the bearish order block. And that's where you start shorting it again and take it all the way down to tag the daily breaker support again. Is that clear so far? Now it got a bit complicated over here because I'm mixing like Elliott wave with price action, and we're understanding how the trend is unfolding. But think about it from like a larger perspective now. Now go on the daily chart, zoom into that daily breaker. Now, how many times was the daily breaker tested for support before it broke? Like when the market is falling, it's tapping into the support zone, right? In the 182.34 level, how many tests were done for the support zone before it broke down? You have to think all the way to the back. In January, February, March, it's been 3 months testing the support zone. Yeah, five. So even if we were thinking that, that the monthly chart is bullish, weekly chart is bullish, but when you see something like this, where the market is falling like a cliff, comes into daily support, bounces, makes a lower high, falls sharply back down again, bounces, makes a lower high, then falls sharply down again, bounces, makes a lower high, comes back down again. So when it's like coming down, 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 it's like gravity is like working to break the support. And it's every attempt which is being made at the support zone, it's making it weaker and weaker and weaker. And eventually that support zone is going to break down. And once the support zone breaks down, it's going to go for the next support zone to the downside, which is not even present. Like the new lows sitting at like 170 something. Like I need to check what that low might be. So somewhere around 168. So we're basically coming all the way down to the next weekly support, which we had drawn out like from 2022. Yeah, that's a support zone. That's good. So once you tag the support zone, it bounced, right? And once it bounced, where did it find resistance? In the daily support zone, which got broken down. So that turned into a resistance zone, and it kept holding the market. So the market was sandwiched between a resistance zone and a support zone. Yeah, like those. Now, the thing is, even though I understand that the market is going to go lower, but shorting over here is a very bad thing to do. Because when you take like, how much has stock fallen from all-time highs? Like, take a measurement of how much it's down from all-time highs. It's down like 15%, almost. So Apple, roughly speaking, does not go lower than 20% from all-time highs. Whenever like a drawdown happens, 20% is like the max. Even like that's recessionary data I'm talking about. 20 to 30%, that's the only drawdown Apple is going to give you. Once you hit the 30% mark, you're talking about like generational bottom to be hit. And that's something you need to be aware of. Like whenever like some kind of a recession happens or a massive drawdown happens, Apple will only give you like 30% drop max. But in like healthy corrections, where the market is gonna go down like for 6 months or like 3 months, you're just talking 15 to 20%. That's all. Okay, so in this case, market is down like at least 15%. So I would be like thinking about, you know, 5% downside is nothing. Like 5% downside is not gonna make you much in comparison. You're much better off thinking about on the long side when the market is down like at least 15 to 20% from all time highs. So you would be looking for triggers when the market structure shifts bullish, and you should be looking to go long. Okay. But right now the market structure is bearish. It's making lower highs and lower lows. So you should be like monitoring the market structure on the daily chart and look for bullish triggers to come into play. And that's where you go long. All right. Now go on the monthly chart. Zoom in. So right now, the way the monthly chart is being printed, it looks like it's going to go for the monthly low at 166. So you should be taking even further zoomed out view. Like remove everything, I would say, just like wipe out the display, like remove all drawings. We'll like start again because there's too much price action which has like gone up and we need to like look at new patterns. So right click and just like click remove drawings. Right. Now go on the quarterly chart. So which pattern do you see here? Yes, draw it out. Also, just a note, you see the giant up candle on the quarterly chart before the large pullback happened? Yeah, this one. The low of this quarterly candle, market should not go below that low if it is like bullish on the quarterly chart. If you break that low on the quarterly chart, it's going to be pandemonium and the market's going to go to like at least 125. But if the market is like just consolidating on the monthly chart, if the market is just consolidating, we're going to stay above the 159.78 low, which means that once you go and take out the 165.67 low, that's where you go long and put a stop loss below 159.78. Now go on the weekly chart, zoom out. So you see the weekly bullish order block, the same weekly bullish order block we were using like a year ago. That same weekly bullish order block is going to save the market. So you're basically like keeping your stop loss below the weekly bullish order block. Now zoom in, draw out the weekly bullish order block. Like our invalidation is 159.78. So there's a weekly bullish order block sitting right above it. No, not this one. Like the we're not doing that. Like that's way down. Just focus on the pattern we have. The pattern is the inside quarterly candle. Yeah, this weekly bullish order block. So the market should not be going below this weekly bullish order block. And look at in our current price action, we have an inside weekly candle where market took out the highs of the inside weekly candle and rejected it, and it's coming down. So which means the next weekly candle is likely going to be a sell-off candle to the downside, and we will be attacking 165.67 in lows. So play out the next week candle. Keep going, keep going. No, no, keep going. Okay, there. That's where you buy. You gotta buy. Like, don't wait around. And put a stop loss below 160 something. Yeah, just follow the weekly bullish outlook. That's good. Yeah, that's good. And you target new all-time highs because the pattern is the inside quarterly candle failure, and if that will play out, then it's gonna play out like this. So you should be flipping this weekly bearish order block, and once you flip the weekly bearish order block, yeah, it's gonna go. Keep playing it. Keep playing it. Keep playing it. Go 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 go. Come on, Apple. Come on, go. Let's go. Let's go. Let's go. Hit the target. Hit the target. There it is. You hit the target. So in essence, what happened right there, this entire consolidation from August high in 2023 to April lows in 2024, that was a giant ABC correction. It was a very, very big ABC correction which happened. So if the market comes back down to 199.62 highs, you long it again. And you pray to God that it comes back down because that when you look at the quarterly chart, go to the quarterly chart now. Now you see how we ran the lows of the quarterly chart and we basically slingshot all the way up. Now that down candle is a quarterly bullish engulfing, which means it's a quarterly bullish order block. You need to pay attention to that bullish order block because there are very few quarterly bullish order blocks which are made in the market, and this is one of them. So if the market ever comes back down to 199.62, you long it over there. Okay, so mark out the quarterly bullish order block. Yeah, right there. Good. So if the market ever pulls back into this quarterly bullish order block, specifically at the highs at 199.62, that's where you long at and expect massive, massive upside from there. All right, so look at the monthly chart now. Monthly chart looks good. Play out the next monthly chart. Keep pushing, keep pushing, keep pushing. All right, that's where the quarterly candle closed. So we went up, took out the month high. So we were basically in. You see what I told you? If the market ever comes back down to 199.62, that's where you long it. And that's what happened. It came back down to 199.62. Go to the daily chart. No, go on the daily chart. Yeah. Play out the price action. Just quick play. Right. Keep playing it. Keep playing it. It's gonna drop and it's gonna come down there, and that's where you're gonna long it. It almost always does that. Like it's a guaranteed thing that it's gonna come back down to test the support. That's where you long it. See that drop which happened with the gap down? That's where the Japanese yen carry trade blew up, and the market like did an immediate gap down. Now even here you can like see it on the hourly chart. The market opened exactly at that level and started like pushing higher. So you would be like, right. You'll be holding it. You see the okay. Zoom into the daily chart. No, zoom in. Keep the take profit, but zoom in. Do you see the gap? The gap up top, like higher, go higher on the left. Yeah, right here. Yes, this gap. That's where it's gonna go. It's gonna fill that. And once it fills that, you exit the trade. Exactly. Yeah, that's good. Click play. Keep playing it. Bingo. Play's done. Play the price action furthermore. You see why I told you whenever you do a gap fill, you should not be holding a trade open like that. Whenever it like fills a gap, it almost always like does some kind of a reaction. And we did the reaction over here. So this is where we're sitting at right now. I mean, the market did that open, like it formed a gap, and like what look what happened the next day. Play out for the price action. See if we fill the gap, the open gap. Now I can tell you this much. It's gonna come back down and it's gonna tag the low at 195 once more, and it's gonna tag the quarterly support zone before going higher again. It's not gonna make a new all-time high just yet. Like we're gonna come back down to test 195 again, and that's where you need to be longing the market once more. I mean, that's it. Like this is current day price action. There's nothing further beyond this. We traded the entire 2.5 years worth of price action on Apple. And Dave is like, I need more data. Give me more data to trade Apple. So do you feel confident trading stocks now? Because if you can trade Apple using price action concepts like this, you can trade any stock possible, which has as long as it's a major company, not like penny stock. If it's a major company, they all work the same way. Apple is very easy. Like it's controlled centrally, and it's tied up to the index. Like it's an index mover, so it respects levels very very easily. Like it does not like fluctuates more than it should. Like and it's very precise with every level and every gap fill it does. So how do you feel about the execution part now? Like are you getting confidence in terms of like executing trades, spotting the setups? Nice. I think we did well with this ticker. I haven't personally traded Apple like this. Like this is like a very, very fast forward way of trading Apple. Like I trade Apple generally speaking using options, like on a weekly basis, but I never do like swing trading like the way I just describe it to you. But I understand where it's gonna go on a swing basis. It's just more profitable to like, do week by week basis with like weekly call options. So you get more profit out of it. Um, but yeah, it's interesting doing swing trading like that. We should do Microsoft next. After like next session, we'll like focus purely on Microsoft, and we'll like discuss how Microsoft influences Nasdaq. So we'll have both Microsoft and Nasdaq in split screen, and we're gonna like decide trade setups on both of them together. But not in this session. I think we've covered quite a bit in this session. All right, so I'm gonna let you go. I'll send the recording for the session. But I think we should meet another time during this week. Which day works the best for you? Would you be available on a weekend? Like let's say Saturday or Sunday? Sunday would be fine. Oh, okay. When are you back? Next week? All right, let's do it next week then. I'll check in with you on Sunday when you're back, and we'll decide on time for next week. All right, no worries. Enjoy your day. Bye.